Michael Burry has stated that the banking crisis is over and has indicated that the fallout from Silicon Valley Bank should soon be at an end and the markets might have bottomed. At least as it relates to the current banking debacle. In a tweet, Michael Burry specifically said this crisis could resolve very quickly, saying, "I'm not seeing the true danger here." Here, of course, referring to the Silicon Valley Bank debacle, but also the subsequent bailouts coming in to help reassure the markets. Michael Burry then followed this up by stating that in October 1907, Knickerbocker Trust failed due to risky bets, sparking a panic. The melodrama aside, Michael Burry is getting the idea by the Federal Reserve and Treasury and the Federal Deposit Insurance Corporation stepping in. It's hoped to reassure markets and the panic should stop spreading. Furthermore, JP Morgan has stepped in with First Republic. JP Morgan has provided additional liquidity to First Republic, and that to some extent might help to reassure markets. Nevertheless, Michael Burry appears to have believed that the crisis has resolved, although it doesn't mean that Burry believes that the markets will go up. He has been incredibly bearish about markets for quite some time, and have become a perma-bear, simply indefatigably predicting a market crisis. Rather, he seems to think that markets will continue on as they did beforehand, which he would believe would be then continuing on to go further and further downwards. Burry has also not been a massive fan of what went on with Silicon Valley Bank, or necessarily with the bailouts, and while he does seem to believe that the crisis has somewhat resolved, he does believe that bailouts and the like were probably better than a bank run. People full of hubris and greed take stupid risks and fail. Money is then printed because it works so well. However, he's really giving the idea here that while the bailouts might have been necessary, but it was to take a stunt to prevent a broader market rout and a broader market downturn. This probably should not have been required in the first place. Rather, they should have been appropriate regulations in place to ensure that Silicon Valley Bank wasn't taking those incredibly stupid risks. That is, to some extent, some regulation was necessary to save Silicon Valley Bank from itself. And even if that regulation required them to have competent chief risk officers, which they lacked for about 8 months, that regulation would have been beneficial in preventing this whole situation to begin with. So Michael Burry appears to think that markets might have stabilized, but this crisis should never have actually occurred to begin with. Now, while Michael Burry appears to be focusing on the United States here, it's possible that what's happening with Credit Suisse is lurking in the background. Credit Suisse also has had a massive downturn nearly contemporaneous with Silicon Valley Bank going under. It too has received something of a bailout, but in this case, from the Swiss National Bank, getting access to some US $50 billion of additional liquidity. Credit Suisse also has been experiencing a downturn for quite some time now, all the way back to the beginning of 2022. There is a massive leak of client data followed by massive client outflows. Either around this is exposure to Archegos and to Greensill, and there was just a death by 1,000 cuts. Credit Suisse also started to lose talent, and when you're losing talent, you're going to lose clients either. And onto this, the debacle is with Credit Suisse's financial reports. There were queries over the accuracy of those reports, and then Credit Suisse disclosed inadequate risk management about the veracity of their provenance reports. And then just to add on to this whole dumpster fire, the Saudi National Bank said that it wouldn't provide any more financial support to the now troubled Credit Suisse. It would not invest any more money in this company, both for regulatory and other reasons, suggesting a loss of confidence in the bank. However, the Swiss National Bank then came in to provide additional liquidity, suggesting a mini bailout of Credit Suisse, thereby helping to at least somewhat support the market. Now, Credit Suisse is not totally out of the woods, but certainly there is a little bit of an improvement. So what was happening with Credit Suisse might also have been feeding into Michael Burry's views about the broader market sector and what was happening with Silicon Valley Bank, and whether the market might have bottomed and whether the whole bailout situation has helped resolve a lack of market confidence. So, is Michael Burry correct? Have markets bottomed? Has the crisis been averted? Has JP Morgan made a stand? Well, the market can be wrong longer than you can remain solvent. And we're dealing with behavioral finance, so people can do that in an irrational manner, even though we might think the crisis should have been averted. Clearly, when Silicon Valley Bank went under, there was a risk of a bankrupt. There's a risk of people shifting their money from slightly smaller banks into larger banks. That was the impact of that so large that it should have wiped more than 50% off the company's market capitalization without an additional change in that firm's fundamentals. especially when JP Morgan and the Federal Reserve appear to have stepped in to provide additional liquidity. So they were looking at the Federal Reserve. The Federal Reserve has done a couple of things. The first one, of course, is have guaranteed deposits up to an unlimited amount. The second thing that they've done is to provide additional liquidity to banks, allowing banks to borrow money from the Federal Reserve and use their existing assets as collateral. There's existing assets being things like treasury bonds or mortgage-backed securities, and the Federal Reserve is going to value those at par, meaning that even if those assets are underwater, even if those assets have fallen significantly in value, as has been reported for many assets, so many banks' balance sheets, they're still going to be able to borrow money as if those were trading at par. This gives significant additional liquidity to pretty much every bank that might need it. Within the US banking system, what these two things mean is that a deposit should be guaranteed up to an unlimited amount. Now granted, this initially was only applied to Silicon Valley Bank and Signature. But the precedent has been set, and it would be extended, one would think. All of this effectively means that there doesn't seem to be a logical reason for a run on any of these other banks at the moment. There doesn't seem to be a logical reason to really be shifting a ton of your money out of all of these banks into JP Morgan. This is especially the case if one has been banking with that institution for a relatively long time, and you've got debt with an institution that you are currently being able to access. So when these large banks are lending, they might give less favorable terms and then not even lend at all. By contrast, the smaller regional bank might be able to get access to better information and better real-time information so they can better monitor what is happening with that organization, thereby giving the organization better access to capital. So therefore, we are likely to see broader support for the banking system, not just for Silicon Valley Bank, not just with Signature, but more broadly. And this therefore means that we shouldn't rationally have more of a stampede. The main exception to this, to some extent, is that if you do fear that your bank is in imminent doom, then people might still ship their money because it will simply be more convenient to have your money in JP Morgan than to have to deal with the whole rigmarole of getting your money out of that smaller bank. Dealing with perhaps, is that deposit really going to be guaranteed? Is the system just going to collapse? What's going to go on? It's just a lot more convenient if your money is definitely safe in an organization that won't have any disruptions. By contrast, Silicon Valley Bank was just incompetence, bad risk management, shoddy management of the society equation, and a really concentrated deposit book, which created a confluence of factors that led to Silicon Valley Bank ultimately going under. Well, at the moment, it is a little bit too early to say, but it seems the Swiss National Bank has come in and has hoped to clear the situation up by providing that additional $50 billion of liquidity. The Swiss National Bank has helped to shore up Credit Suisse balance sheet. Furthermore, Credit Suisse doesn't appear to be in nearly the same dire financial situation as, say, Silicon Valley Bank. It appears to be reasonably well capitalized. It's been reported that liquid assets can be at least 50% of the deposits, meaning they can manage a significant deposit drawdown without it creating a catastrophe. However, of course, hurting can ensue. Hurting can occur and people might launch a run on the bank, but that doesn't appear to be the case at the moment. In the United States, it was necessary for them to guarantee deposits and then provide some additional liquidity for these banks. Not ideal that they needed to do so, but necessary. With Credit Suisse, it was necessary. The Swiss National Bank came in to reassure the markets, especially after the Saudi National Bank declined to provide additional funding. Many of these banks, whether it's Silicon Valley Bank or Credit Suisse, should have taken steps to assure that this debacle would not arise. But it appears that the regulators come in and at least staved off the worst of it. Thanks for watching. Until the next one.